Well, welcome everyone. My name is Charles Buck. I'm the president and CEO of United Church Funds. We're just delighted that you have joined us this day. I want to welcome you all and also to say that in these weeks of Easter, we hope that you're well, that you're witnessing signs of renewal and resurrection in your lives and your communities. If we could have the next slide here so you can see the agenda for today. We've got a full agenda. We've got a lot of things going on, but I want to start off by saying to all of you that we certainly here at United Church Funds are seeing Easter. We're seeing renewal and resurrection, and we are cautiously optimistic. We're optimistic about vaccinations, but cautious out of concern over access and availability issues throughout the world. We're optimistic about the capital markets, about the general economy, employment rates and consumer demand, but we're also cautious because of possible inflation, higher interest rates, supply chain disruptions. We're optimistic about the reopening of cities and workplaces, restaurants and entertainment venues, and certainly churches and places of worship. But we're cautious because we can move too fast and maybe trigger a new wave of COVID. We're optimistic following the Derek Chauvin verdict in Minneapolis, but we're also cautious, knowing that the pursuit for racial justice has a ways to go, and we have to continue that good work. But regardless how things turn out, whether they're good or bad, up or down, we've got our mission, God's mission to live out. And here at UCF, we consider it a calling to support your mission every day and all the time through outstanding values-aligned investment. On the next slide, you'll see our staff of dedicated professionals all listed here, some of whom you will see this in this webinar. I'll tell you that every single person here is devoted to the mission of supporting your mission. In fact, I will tell you, while all of you have account numbers, those are for the computers at the office. We know you and we call you by name because we feel that our work with you is personal, intensely personal to us. On the next slide, you'll see our board of directors and investment committee members, extremely diverse, highly competent group of professionals from a variety of fields, including ministry, finance, investment, law, nonprofit management. But really, they're all just like you, active local church people doing God's work. And if we could turn the slide. What we want to say here is that investing with a mission is something we've been doing for you for over 100 years. And our intention is to keep on doing that for you until the reign of God is at hand. Well, I'll end here and turn it over to Matt. But first, I want to say thank you for allowing us the privilege of being partners with you in faithful stewardship. And in that regard, we are not cautiously optimistic. We are wildly enthusiastic about working with you to make a just world for all. Matt Wagner.
Charles, thank you so much. I really appreciate that introduction to this webinar and this time together with our clients. Debbie, if we could see the next slide. I want to just highlight the work of Debbie Wibowo behind the scenes while we're flipping slides here. Debbie is joining this call from Jakarta, Indonesia, 4 a.m. her time, doing yeoman's work for United Church Funds while she visits with family in her native country. And Debbie, we wish you safe travels home and are grateful for your service to this organization and to our clients as well. Your work definitely does not go unnoticed. Just a couple of organizational updates from us today before we kick into some information regarding responsible investing activities and some market updates and thoughts on performance and markets moving forward. We were pleased at United Church Funds to, for the first time in our organization's history, cross over the $1 billion in total assets under management threshold. You did not see a press release from us on this because we have been doing this long enough to know that markets do go up and down, but through prudent investment management and the addition of many new clients over the course of the last decade or more, we are pleased and indeed humbled to be the trusted investment partner of 1,100 institutional clients and $1 billion in total assets under advisement that we seek to manage in a responsible and prudent way for our clients. As a quick reminder, which you may have seen at the beginning of if you watch the first town hall of the year, we announced and will remind you that we were able to lower expense ratios or the fees for all of our funds in 2021. Each fund saw somewhere between about a 5 to 8 basis point reduction in fees. That's a byproduct of United Church Funds performance of the performance of our funds in 2020. A little bit of tightening our belts, as many of our clients have been doing in these challenging times, and the addition of new assets. And so our goal at United Church Funds, as I'll remind you, is to add to our funds and services over time and hopefully reduce fees for all clients. And we're able to do so in 2021. As we look forward to the summer, we're very much looking forward to being a gold level sponsor of the 2021 General Synod 33 meeting, which will be held in July. It will be a virtual event at a website called meet.ucc. And we are very much looking forward to being a part of this event, and we'll be hosting a workshop sometime between July 7 and 10, date confirmation to be determined, but we hope that all of you will join us for our workshop and join the broader setting of the United Church of Christ at this very important event. In the first quarter, changing gears to maybe a closer look at our funds, we have added or in the process of adding 2 new managers. We added a manager to our small cap equity fund, a value manager called Channing Capital. They're out of Chicago. Channing has done a fantastic job for us since adding them on February 1st. And as it stands today, we have about $17.3 million invested with them, which makes them, as of the end of April, our second largest small cap manager in the portfolio at large. And we are in the process of adding a new alternatives impact manager, Lumos Capital. Lumos focuses on capital developments or human capital developments in the areas of education technology and workforce development. Some of their portfolio companies, IronHack provides courses in digital content for folks in the workforce. Elevation provides resources and technology for English as a second language students. And so what they're attempting to do at Lumos is to make a real impact in society through those investments, and certainly proud to have them as part of our alternatives fund. And then lastly, throughout the United Church of Christ over the last 18 months or so, United Church Funds has, through the Brown Endowment, supported efforts of conferences and associations, and indeed the national setting. About 20 conferences have benefited from 17 different grants that we partnered with conferences on to support clergy and lay folks during these challenging months. And indeed, over the last 18 months, hundreds and hundreds of lay folks and clergy have benefited from those grants. And we certainly look forward to continued partnership with conferences. So with that, I would like to turn it over to my colleague, the Director of Responsible Investing, Matthew Ilian, who's going to be providing some of his top 5 initiatives for responsible investing that we've been working on recently. Matthew?
Thank you, Matt, and thank you all for being here. So yeah, to kick us off on the top 5 stories that we are following, the context of this first story is that we're in the thick of shareholder season. And that means that this is the time of year that most corporations hold their shareholder meeting. And it's also the time of year when faith and values investors like us and our peers and colleagues have the chance to get the ear of our fellow investors and also the ear of corporations when we file shareholder resolutions. So coming in at number 1, if you'll turn to the next slide, Debbie. Yes, or this slide right here. For the first time ever, diversity and racial justice is the top issue area for shareholder resolutions among our peers at ICCR, the Interfaith Center for Corporate Responsibility. So you can see, if you look closely on this slide, that there were 64 resolutions that were filed that had racial justice and diversity as a focus area. And in fact, we filed 3 of those resolutions with peers at a shareholder advocacy group called As You Sow. 2 of those resolutions did not make it to the proxy because we agreed with the company that they had made progress, sufficient progress. One, I'm actually really excited to share with you because the resolution at American Express, that shareholder meeting was today, and we just found out today that we got a majority vote on that. And so majority of shareholders have asked American Express to do more in the disclosure of the work that they're doing around racial justice and diversity. And so we're really excited to share that. We don't have the final numbers in, so we'll share that in a blog post with you all. I think I want to just summarize this point by saying that it's not enough for corporations these days to merely disclose their diversity numbers and say that's enough. Investors and the public clearly want to see corporations take this moment to take stock of what they are doing to contribute to a culture that promotes diversity and inclusion. And it's not enough to just have diversity in the warehouse. We're looking for diversity in the C-suite. We're looking for diversity in the boardroom, and for there to be an authentic effort put forth. So anyways, exciting topic there. The second, number 2, if you'll go to the next slide on the top 5, is really around this area of fixed income investing. And so you'll see this slide says that green, social, and sustainability bond issuance has doubled in 2020. And you can see the green, the blue, and the purple. The biggest jump going, last year is really the social bonds. And these are the bonds that finance affordable housing. Social bonds help finance microfinance efforts. But most importantly, in 2020, they also help finance COVID recovery. So for example, one of the investments that we made through a manager was a $1 million investment in the African Development Bank's COVID recovery bond. This helps provide low-cost capital to African countries and governments to help keep hospitals open, help keep food to the most vulnerable. And we, this is an area that we are very proud of. This type of investment, particularly in our fixed income investments, because at the end of March, we tallied all of our green, social, and sustainability bonds, and they represented 39% of our total fixed income investing. And so this is really not a testimony necessarily to what we're doing, but to our clients, to you, and the priorities that you have for the way that your money is invested to achieve a double bottom line. And the great thing about it is these bonds are all, financially performing strongly. So as I transition to the next topic story we're paying attention to, during Joe Biden's campaign, he pledged to rejoin the Paris Accord on day 1 of his presidency. So it took a little more than a day, but on February 29th, President Biden announced that the US had officially rejoined the Paris Accord. And with the help of John Kerry and Gina McCarthy, on April 22nd, Biden announced the US would target reducing emissions by 50% below 2005 levels by 2030. This was kind of a courageous commitment. And in between those 2 dates, there were also critical developments at both the Department of Labor and the SEC that is making it easier for institutional investors like ourselves to prioritize ESG, or environmental and social governance factors, in our investing. So we're really delighted to see that the government is making a pathway for preserving our planetary balance. I mean, we think this is just an absolute necessity at this time, and we're glad to see it. At the same time, we also need private sector support. So, the government can only do so much. And many companies are making commitments to transition to a green economy. But, let's be honest, there's some suspicion around how much the commitments are worth. And are they just on paper, on websites at this point? So are they sincere? So coming in at number 4, we'll go to the next slide. To combat greenwashing, There are now 129 American companies who have created science-based targets. And the two most recent additions you'll see we've highlighted here is the first is Ford Motor Company, and then NRG is a big utility company. When you make a science-based target or commitment, you agree to have independent auditors to review your goals and your progress. And we at United Church Funds, we're partnering with this group called the Climate Action 100. And that's representing $54 trillion of institutional investors, 575 investors. And we're focusing our energy on companies like Ford, like NRG, that represent 80% of the world's industrial emissions. And so we expect to see more setting science-based targets. We want to give credit where credit is due. A lot of these companies don't often get credit for the good things they're doing. So at Ford and NRG, we're happy to see that they're not only making a public commitment, they're setting a science-based target. And we're expecting to see progress on that, and we will hold them accountable, as well as these independent auditors. So last and certainly not least in this top 5 stories is the story around a just transition. And it's related to the green economy because economists are estimating that over the next 10 years, it's going to cost $90 trillion of new investment to move our global economy from the economy it is now to a green and sustainable economy. This will mean a tremendously difficult transition for nearly every sector of the economy. And it especially for those sectors that are contributing to the highest in greenhouse gas emissions. But it also means there's a lot of money to be made. So there's opportunity here for those businesses and enterprises that are positioning themselves to be able to profit from green economy improvements and needed infrastructure. The point of a just transition is that we don't want to leave people and communities behind as the economy is forced to evolve. The green economy will not be a success if big business views this as a chance to simply cut costs from a formerly high-paying union jobs. We need skilled workers to be retrained for well-paying green economy jobs. Perhaps the most important element of a just transition is that the solutions for preserving the dignity and optimism should not come from just the executive suite, not come just from Washington, but should come from the very communities that have the most to lose. And in many cases, these are the communities that have already lost the most. A just transition means that solutions are coming from the front lines. And we want you to pay attention to this. We certainly are. This is a way for investors who have a values-based lens to ensure that this green transition is also just. And so there you have it, top 5 in SRI. And with that, we now have a poll question. We just want to engage with you who are here today. And so Debbie, if you'll pull up this question, how soon does your church, and we'll say church or faith-based group if you're representing another faith-based organization, plan on resuming in-person worship or plan on coming back together in person? If you'll just take a minute or two here to let us know where you stand, it's just helpful for us as we work with you, as we serve you, to understand where you are in this process. All right, we've got the results coming in, and Debbie, when you're ready, if you could, I'll give everybody another 10, 15 seconds to put your vote in, grab a drink of water, and we would like to see where you are. Okay, so most everyone has already resumed, and it looks like there's a lot of folks who have a 30 to 90 day window that they're looking at resuming. So it's certainly, we're happy to see life starting to get back to normal. And as Charles said in the beginning, we have a lot to be optimistic about. And being able to look at each other in our real eyes, not just our virtual eyes, is certainly part of that. So if you click the close button there, thank you. And so now I want to turn this presentation over to my colleague, Stacy Pettis. Stacy's going to take us through the economy and what we're looking at in the investments. So with that, Stacy, I'll hand it over to you.
Thank you so much, Matthew. And thank you all for being here again with us. We wanted to take a little time to discuss some of the themes for the first quarter of 2021 as we look at the markets. So markets have continued to improve as the economy recovers. The positive performance that has been seen in global equity markets were led by US markets with a shift to smaller companies and economically sensitive stocks. Fixed income returns were mixed this past quarter, with returns being negative, actually, which have been due to the impact of rising rates. As we look at the economic growth, the economy continues to show signs of improvements, which is a result of the increased rate of vaccinations and the availability that we now have, especially in the United States, to get access to the vaccine, as well as the unprecedented fiscal and monetary stimulus that has been so present across the globe. And so when we think about how we invest as a long-term investor for faith-based organizations, our investment team continues to be mindful of increased risk and potential opportunities that may arise in volatile times. And so the active management and engagement that is happening on your behalf is so important and so vital to how we manage assets for you. When we look at what's going on a macro level, the resurgence of the pandemic as reopening continues. So there are some nations that are really struggling right now. There are some places in our country where we're seeing resurgences as well. There's also trade tensions that continue with US and China, as well as social and political unrest. When we think about our long-term strategy as faith-based investors, we continue to really invest for the long term while balancing your needs for continued liquidity and returns through asset allocation decisions and manager selection processes. And flipping over to the next slide, this is just an overview of selected index market returns. And so as we look at market index returns, we see that equity markets were positive in the first quarter of 2021, and that was mostly led by small cap and cyclical sectors and value stocks. When we look over to the fixed income side, those markets were negative, and long-term treasuries have been most affected by the rise of interest rates, which we see reflected in the 30-year treasury number. The next slide highlights some of our actual UCF fund performance. So I wanted to take some time to look at our international funds. So our international equity fund continued to have strong performance, which this quarter was actually led by our manager LSV Asset Management in the international developed space, and then RBC Global in our emerging markets equity space. And then as we look at a 5-year annualized return of our international equity fund, it's returned 11.17%, which is beating both the benchmark and the Lipper peer group that we measure our fund performance against. So we've been really pleased in that area. Also, small cap equity has led markets in the past 2 quarters, and our fund was up 10.32% in the first quarter of 2021. It trailed the benchmark and peers some, but looking at the long-term numbers, when we look at the 3 and the 5-year numbers, our small cap equity fund actually exceeds both the benchmark and peers. So we're pleased to see that as well. Our domestic equity fund actually bounced back in the first quarter of 2021, returning 7.09%, which was ahead of benchmark and Lipper peer group. And although UCF Fixed Income Fund beat benchmark in the first quarter of 2021, there's still negative returns that are present in the overall market due to the rising rate environment. So in sliding over to the next slide, slide 17 and 18, actually, you are very familiar with this chart. This is our overall performance chart of all of our funds across various time periods. This chart also shows you the benchmarks and the Lipper peer analysis for comparison purposes. And this chart is available on our website so that you can spend more time looking at this in greater detail. The next slide is actually an illustration that allows you to kind of get an idea of how the market has been performing as it relates to the economy. As we continue to see things opening up, we're seeing positive activity and improvements in leisure and entertainment. And some of you might be taking part in that over the summer, traveling and getting out and doing more than we were able to around this time last year. So we're seeing a lot of positive movement in those areas, which speaks to just the pent-up demand that's been there over the past year or so. Next slide. Great. So markets do appear to be strong in the near term, but we know that this is being buoyed by the fiscal and monetary stimulus packages. But eventually this will need to get paid back, right? And so we see this near-term strength, but long-term, it is a question of how does this all get paid back? So we'll most likely see some changes to the taxation policies that will be coming in the next year to 2 years or so. In the next slide, as we mentioned earlier, small cap has been leading returns for the past 2 quarters, which has been correlating to the recovery in the US economy. We can see in the chart over to the left that small company stocks in sectors such as healthcare, financials, and industrials, just to name a few, have a greater percentage of index market capitalization than large cap companies. So we're starting to see a shift over to small cap companies, which also leads me to the next slide to talk about growth versus value. So although growth stocks have been outperforming value stocks for over the past decade, growth stocks have become relatively expensive and value seems to be well positioned for a comeback. And we've seen it gaining strength since November of 2020 last year. And so we have no crystal ball to tell you exactly what's going to happen, but our value managers especially are really excited about what they think may be to come in this space. So we'll start to see some of that reflected in our portfolios as well. And flipping over to the next slide, this just gives you a look at the fixed income markets. Not a great compelling story right now as prices are declining with rising rates. I'm sure our investments team will speak a little bit about the fixed income markets right after me, so I'll leave that to them. And so in looking at the next slide, we talk a little bit about some macro risks that are out there. And this is actually a chart that we showed last quarter as well that takes a look at the fact that the top 10% earners receive over 50% of the wealth in this nation. And that same top 10% of income earners only spend about 64% of that income, while the bottom 90% spend 99% of their income. And so given this income inequality gap that exists and has been exacerbated by the pandemic, we're going to start to see our government having conversations to see how we get to reduce that disparity. And so I'm sure that will be coming up in some of the tax policies that end up being changed over the next year or so. And in the following slide, this is just a heat map that shows staying diversified and having a diversified portfolio, how it can be beneficial for you in the long term. So active investment managers will tilt allocations within a diversified portfolio to take advantage or avoid certain asset classes and strategies when needed. And that's exactly what our investments team has been doing for you and continues to do for you on a daily basis. And so with that, I have the pleasure of introducing our awesome investments team led by Dave Klassen. We also have Manoti Dhanaraj and Lan Kai on the line with us as well to talk a little bit about the future outlook in the markets and speak a little bit about our managers and what we're doing going forward. Dave, I'll turn it over to you.
Thank you, Stacy. Excellent job as always. I don't have a top 5. I have a top 4. So we're whittling down to what's really important to generating returns for you folks. And I mean, there's no question from a market perspective and a return perspective, it's been an extraordinary period. And as Charles indicated, we're optimistic, but obviously keeping an eye on all of the risks. And so for us, I'll say a couple of obvious things, but then really talk about, and Lan and Manoti and I will talk about how we're positioned, which is really the output of all the things we are optimistic about and cautious about. So, they are as follows. Everybody's talking about the vaccine deployment, even on this call in terms of the inconsistencies or consistencies around our nation or need globally. And I mentioned, the difficulties, the incredible difficulties in India, which brought to everyone's, attention. Clearly, Stacy alluded to tax policy and fiscal and monetary policy, which are important, but the market does not seem deterred by the optimistic and ambitious plans of the Biden administration, particularly given the fact that Janet Yellen is the Secretary of Treasury and has gotten very good at really assuaging us in terms of their stance. Stacy talked a lot about market versus this, sector risk, and I guess it's very important to look forward to where the opportunities lie, not only in the market indices. And again, we do have some passive low cost indexes, but I think at this point in the market cycle, particularly given the uneven recovery, we favor active managers of the ilk of Channing Capital. And so I'll say a little bit more about that. And finally, yes, we've all noticed that all of a sudden interest rates have started to rise, although the last couple of weeks things have really calmed down. But obviously negative returns in fixed income for a bit after a robust 2020. And the question is, will that continue? So I'm just going to make one summary comment, and then I'll leave it to Lan and Manoti if they want to add. But at this point, you may know that since the middle or early part of last year, we had added pretty aggressively, is the wrong word, prudently to our equity exposure. As the market has gone up, we have trimmed slightly here and there, but generally at the end of the year and at the end of the first quarter, we were overweight equities relative to targets. So for example, many of you own the Moderate Balance Fund, where the target equity exposure is 60%, and we were about 65%. So 5 or in some cases 6% above the target. And we also have been, and this has really benefited portfolios, and I may have mentioned this last time, we have been underweighted fixed income and held cash instead, which is, that sort of combination has added a lot to return in terms of asset allocation and helped all of the funds, as Stacy mentioned, be ahead of benchmarks and also ahead of peers. So it's been a really nice period. With that, maybe Lan, if you have any thoughts on interest rates or anything to add to what I've said, now is a perfect time.
Sure. Thank you, Dave. And then I'll make it 5. The 5th observation, then we come for 5 today. I think that I would echo what Charles had made at the beginning of this meeting. We are very optimistic in terms of the economic improvement and earning improvement, and also the very supportive policy responses, both physical side and monetary side. But also we're cautious at the same time, valuations being high, inflation might be not transitory, so it be causing the rates to go further up. And I think there is a question in the Q&A that the duration of fixed income portfolio has been reduced. That's our answer. And then as Dave mentioned, that we have cash and the lever to improve the performance. So on that note, we're always optimist and then cautious, and then try to be nimble and then do the best for you. Menotti, would you like to add anything?
Hi. Yes, no, I think the two of you really covered most of what is happening, and just wanted to reiterate the benefits of our diversified portfolio with having both growth and value managers within the portfolio, within the equity side, and then also having the diversification on the fixed income side. So as you've seen, and as Stacy noted earlier, we've had quite good performance over the past couple of years, and I hope to continue.
Well, Dave and Lana Menotti, thank you for wrapping us up with the slides. We do have a little bit of Q&A, and Debbie sent me a note to make sure that I restart my video. Sorry about that. A little bit of some questions here that have come in throughout the slides here, and so I'll leave it to you all to determine who responds. But we did have a question, and Menotti, to your point about adding both value and growth managers, or having both value and growth managers in the portfolio, and adding Channing, wondering if one of you would like to take on maybe a little bit of a further introduction of Channing Capital, and what they're doing from us, what their underlying strategy is all about, and how they fit in within our overall portfolio.
Menotti, that would be a perfect question for you.
Sure. So Channing Capital Management is a fund that we started investing in the fourth quarter of 2020. And we've been familiar with the fund and the strategy for a couple of years now. And they're a fundamental manager. So they really look at the fundamentals of the stock, know the management, do a deep dive, do a DCF analysis, which is a discounted cash flow analysis, of every one of their stocks that they follow. And they have not too high turnover compared to their peers, and make sure that they do have a very concerted effort and diligence in following their different securities within the portfolio. Thus far, so as Matt noted, we started investing in the fund as of February 1st. Sorry, we got the approval in November, but we started investing as of February 1st. And it was actually great timing, because the fund has done extremely well since and outperformed for us. And so we're very pleased with the strategy. And as Matt noted, it's a value strategy. So it's helped to diversify our portfolio from the managers that we currently have in the small cap space.
The only other thing I would add, in terms of the ways in which United Church Funds invests in the strategies that have been outlined by Stacy, they are predominantly accounts that are run, especially for us, where we can implement our screening policy for industries and companies that we don't want to invest in, irrespective of how well they're doing in terms of being engaged. So there are sectors that we will not invest in, and those portfolios are customized for us.
Dave, thanks for that. And there was a quick follow-up question that said that whether Channing replaced an existing manager, or whether they were an add-on to the fund. They did replace an existing manager, an existing value manager that we had in place. So if there are any additional questions, please put those in the Q&A. I'll take one more that we got early on. And again, Dave, Lana, Menotti, feel free to chime in as others may be typing their questions. We mentioned briefly, and Dave, you alluded to the fact that with Janet Yellen's leadership at the Fed and you know the Biden policies have been fairly, you know, consistently you know, embraced, I guess, if you will, by markets, given recent performance. Are there any changes in the administration in DC that are specifically impacting our investment strategies or the way that we are allocating assets either in the total equity fund or the fixed income fund? So specific to policies that we believe are going to be in place?
No, Matt, the only thing I can really think of is are policies related to the carried interest in private equity and the taxation issues that might certainly would affect, you know, all private equity to some degree, but we're not exposed incommensurately with any particular policy issue, and I think we're not unique in that way.
Dave, thanks. Another question just came in from Mel Boynton from Claremont, California. Mel asked about the size and perhaps the performance, if you want to speak to that as it relates to the Beyond Fossil Fuels Fund specifically. I can speak to the size of the Beyond Fossil Fuels Fund. Let's remember that we started that fund at November the 1st, 2014. We started that with $20 million from a set of founding investors. And that fund and strategy now has grown into a global equity strategy with a total assets under management as of the end of the quarter of just over 112 million. So that growth has been through, you know, organic through performance and also through the addition of new investors over the course of the last 7 years or so, 6.5 or 7 years. Dave, do you want to speak to performance?
Yeah, sure. Have it in front of me. Great question, because it's a very important fund for us. As you know, we were one of the first denominations to divest of fossil fuels. Specifically, the Beyond Fossil Fuels Fund on page 17 of the presentation was up 7.95% for the quarter. That compares to the index of 5.14%, so almost 300 basis points, 3% better than the benchmark. And on a one-year trailing basis, the fund was up an astounding 59.4% versus the benchmark of 57.58, and the Lipper Global Equity Peer Universe up 55. So performance there, after a little bit of a tough period where their strategy wasn't terrific, has really rebounded nicely. So we're extraordinarily pleased. And I'm speaking, our team is speaking to the Massachusetts Conference, one of the founding members, to give them the good news that they probably know already.
Dave, thanks. Another question as it relates to a manager we briefly introduced at the onset of the presentation, Lumos Capital, in their work in private equity as it relates to education technology and workforce development. Any words about Lumos in addition to that, and when we expect them to be allocated to the portfolio?
Well, I'll just say one thing, and then Lon can either type in or answer. That's an option, to be able to type in. And thank you. Nice to see you on the call. And yes, we are adding to the alternatives fund. Lumos is an addition, and I think alternatives, particularly positively impact are very attractive in this environment, particularly given the low expected returns in fixed income. So we've signed the paperwork, we've gotten approval, and capital will be called over a period of time. But there's a $5 million commitment that United Church Funds and the Alternatives Fund has made to Lumos Capital. Anybody, Lon, care to say anything else about what I may have missed? I don't think so.
Okay.
Yep.
Yep. No. Well, thank you, Dave. And as you alluded to, certainly alternatives and even some impact strategies within alternatives are an important leg to the stool of diversification. And we certainly do that through the Alternatives Balance Fund and have that standalone as the Alternatives Fund as well. So, again, to all my fellow panelists, I want to say thank you. It looks like we've come to the end of the Q&A. I want to thank everyone for participating, all of our clients and friends and stakeholders for being a part of this call. We're greatly appreciative to be your trusted partner. Thank you very much for entrusting us with your assets. We look forward to seeing you again on future town halls and future opportunities. If you have not signed up for updates from our website for updates via email, I would encourage you to do so. You can go to our website at ucfunds.org to do so. We promise not to inundate your inbox with emails, but we do send out important updates from time to time, and would love to stay in touch with you that way as well as our personal interactions with you all. So with that being said, thank you all very much for attending, and have a lovely evening. Take care.